Wagwan, you multifamily enthusiasts. Welcome to another episode of the Multifamily Real Estate Experiment Podcast, where we break down the mindset, mechanics, and market intelligence needed to help you own more of America. Now, today's guest built a real estate empire, lost it in 2008 crash, and then rebuilt it stronger than ever. And listen, some of you meet roadblocks in your life and think it's the end of the world. But most of you understand that it's a setup for the get up. We're going to talk to Kevin Bupp today. Kevin Bupp is the CEO of Sunrise Capital Investors. He has over $500 million in real estate in transaction. He hosts a top rated real estate investing cash flow podcast. He's also the author of The Cash Flow Investor and one of the country's most respected voice in the mobile home parking lots. And also, which is a unique niche in commercial real estate assets. His insight has been featured everywhere in the bigger pockets, the International Investment Conference, and today he's here to teach us what most mainstream investors completely overlook. Kevin, welcome to the Deal Lab, brother.
Hey, Hutch. Thanks for having me. I'm excited to be here.
Yes, sir. Brother, do you have a favorite real estate quote or mantra that drive you? Let's talk about that before we get into the tactical stuff.
Yeah, that's a good question. I'll share two with you. I've got two young sons. They're 9 and 12. I say this to them all the time. This is applicable to any part of your life, whether it be real estate investing, sports, business, marriage. Get comfortable with being uncomfortable. Like throughout your
Yes.
life, you need to get very comfortable with getting outside of your comfort zone and being uncomfortable. So that's the only place we find growth as individuals. And then the other one is I'm a big fan of Warren Buffett. One of Warren Buffett's famous quotes is rule number one, never lose money. Rule number two, never forget rule number one. So we live by that at Sunrise Capital.
Yeah, that is awesome, man. Look, I've been in the Marine Corps for a while now, and some of the best relationships that I've made is being in really uncomfortable situation and environment with limited resources that we consider austere environments. You get
Mhm.
to see what drives you, what fuels you. You get to see what you do, why you do it, and you'll get to see the people around you what makes them tick. You get to see their growth as well. You also get to see the ones who break. So you get to see the ones who are dependable, and you also get to realize that you may or may not be a dependable person as well. You know what I mean? So the discomfort really drives you to a higher level of growth in multiple
Absolutely.
situations. Yes, sir. Now,
I
Kevin,
agree wholeheartedly.
yes, I appreciate it. So you built $100 million plus portfolio, and then in 2008, like a lot of people have seen a multiple market cycle, lost everything. Most people never recover from that. Can you walk us through, brother, what you did? What did losing your portfolio teach you about leverage, risk, true fundamentals of wealth?
Yeah, it's a great question. It was a very challenging time. Had found some significant success in my early to late 20s leading up to '08. I built a nearly $100 million, about $75 million real
Right.
estate portfolio of single family homes and multifamily properties in Southwest Florida. The first big lesson that took away from that is a large majority of my portfolio were single family properties. The operational side of that, we owned properties spread amongst 5 different counties. It was a very inefficient process. It was very expensive to manage them.
Okay.
Technology exists today that didn't exist back then, that creates a lot of efficiencies that weren't really in place back then. And so while I had low leverage points on everything, I wasn't making a lot of cash flow. I speak about cash flow today because really it's our number one principle. But if I'm going to be brutally honest with myself, my portfolio was more built around appreciation that kind of rose with all the tides in Florida. Florida is a very cyclical market. It goes to really high peaks and it goes to lows. And that's typical of a lot of the coastal markets. While I made some cash flow, it wasn't durable enough to withstand negative impacts that occurred during that period of time. A lot of folks say rents never go down. That was not the case. There were periods of time where we had oversupply of homes here in Florida. And so that impacted our rental portfolio. In addition to that, when they stopped building new homes, a lot of the jobs went away. And so there weren't as many, the population slightly decreased in Florida. Folks had to move other places to find work. And so we had challenges maintaining occupancy. And so once you start stacking all the challenges, maintaining occupancy, lowering our rents, offering concessions, we had challenges meeting our debt service. And in addition to that, the values of these properties, even though we had low leverage points, we had built in equity, a lot of them within a period of a year were upside down in value, even if our leverage point was in the 60% range. So we were pretty conservative, generally speaking, but we lost nearly 50 or 60% of the value in a period of a year. That value has since come back, but we didn't have the durability to weather that storm. We look at things very differently today. We put a lot of stress tests in place on our properties. We're still very conservative with leverage. However, we look at worst case scenarios. We underwrite to various cliffs within the financial model to ensure that in the event of a worst case scenario, can we still make debt service? Can we weather the storm and carry it through to the other side? And so that's probably the big difference and one of the biggest lessons I took away from that period and how we've restructured our portfolio today. We just had a challenging couple of years with interest rates going up. A lot of folks are in trouble. A lot of folks had short-term debt in place. We have not missed a quarterly distribution. We're proud to say that we've literally made 34 quarterly distributions in a row. We've gone right through COVID, going right through the last couple of years with interest rate increases. We don't have adjustable rate debt. We've got long-term debt in our portfolio. And our leverage points are low. And even if we lose occupancy in any of our assets, it has not impacted our ability to pay distributions and debt service. It's a very durable portfolio versus what looked good on the outside of my old portfolio. When you really got into the nitty gritty, you found that there was lots of weak links on the chain. And so just lots of lessons learned, but those are some of the big ones.
We are as strong as the weakest link in the chain.
That's
And
right.
I want to talk about mobile home park because you probably deal with this question quite a bit. And I think it comes from a place of lack of understanding. We drive past these things and don't really quite understand mobile home parks. You have doubled down on mobile home parks when most syndicators chase apartments. I would like for you to help our listeners understand what makes mobile home park one of the most recession resilient, high demand, with limited supply assets in the commercial real estate space.
Yeah, that's a great question. Funny enough, I know you're based in Hawaii. Hawaii is the one state that does not have any mobile home parks. They don't exist there. Probably the cost of transporting the mobile homes across the ocean, and
Yeah.
there's no manufacturer there for mobile homes. I've always been a contrarian investor. I always try to, where's the herd going? What's on the opposing side? Is there
Mm.
opportunity there? Right. And so, mobile home parks now are pretty popular in the mainstream. Lots of institutional money is in the space. That wasn't the case 13 years ago when we started buying them. It was a very unrealized niche. If you knew, you knew, but if you didn't, you didn't. It was
Mm.
like a little good old boys club. Lots of mom and pop type owners, not big
Right.
institutional groups. And once we identified a potential opportunity there, we bought a property. I didn't know. I know apartment complexes, owned portfolios of single family homes, owned other type of commercial real estate. I didn't know what I didn't know, and there wasn't a lot of information out there. What I did know is that the affordable housing crisis was real 13 years ago when we started buying mobile home parks. It's even more real today. Mobile home parks offer what I feel is the best unsubsidized housing option in any market across the country. You can
Huh.
take any of our mobile home parks in any city that we own across the country, and I can promise you that it's a better quality than what you're going to get for the same price point in an apartment complex. More than likely, it's half the price of the same size stick built home. Our competitors are apartment complexes. We offer the American dream to those that would otherwise be renting an apartment, but for a much less price, they can live the American dream in a brand new mobile home than what they might be paying to live in a B minus or C plus class apartment complex. It's a very compelling picture that we can paint to provide beautiful form of housing at a very affordable price. And so I bought that first property 13 years ago. Didn't know what I didn't know, bought it, stabilized it, did a lot of improvements, and it filled up very quickly. We made something very nice. It was in a good part of town. It was in the good school district. So folks wanted to live
Yeah.
there, wanted to raise their kids there, right? They want to send their kids to the good schools. They're good, hardworking, blue collar folks, but they needed an affordable place to reside and raise their family. And that's what we provide. That hasn't changed. That's still the same storyline today. But the unique thing about mobile home parks is that it's one of two asset classes that has a diminishing supply, meaning that there's more mobile home communities that get torn down or redeveloped every year, meaning that there's a
Yeah.
shrinking supply than new supply that comes online. And so we've got this unique asset class to where if we buy in a great market, in a great part of town, we can fix it up, do great things with it. We don't have to worry about a new competitor being built right down the road. It's a very isolated asset class and also has a significant barrier to entry. Whereas when self-storage or apartments, you've always got the concern of potential oversupply, someone else
Mhm.
coming in and building too many units, and then that ultimately impacts what you might be able to charge or how fast you might be able to lease up.
Yeah, that is interesting, man. So there's a couple of different ways, to my understanding, that we can run a mobile home park business, right? I'd like to dive more into your business strategy as
Mhm.
far as as a practitioner, right? Where the residents they can own the mobile home and just rent the lot from you, or you yourself can own the mobile home and the lot and the maintenance that comes along with it. Which one of those you see to be more successful, or do you do a practitioner of both, multiple?
We're a practitioner of both, but only out of necessity. The ideal business model is we don't own any of the homes. We just own the property, the infrastructure, and we rent the lot to the residents and they own the home. When they own the home, they're responsible, like a homeowner would be. They're responsible
Right.
for if the roof leaks, the plumbing leaks, if the AC breaks, right? They're calling the vendors. They're not relying upon landlord to fix those items, right? And so the expense load is much lower when we don't own that unit. When the resident owns that home, it's very akin to that of a stick-built home. To them, they're living in a subdivision. What that means is we've got a significantly lower amount of turnover of resident base. Whereas with renters, they might be moving every 12, 18, 24 months. We've got residents that have lived in some of our communities for 4 decades. Even there's a couple that have lived there for 5 decades. And there's multiple, components of multiple generations living in that same community as well. So you got entire families, 2, 3, 4 generations of families living in some of these communities. And so they don't leave, they stay. They're sticky resident base. And so we like that. They've got a pride of ownership. There's a sense of community that just doesn't necessarily exist when you have renters and the units. And so, again, in a perfect world, we wouldn't own any. However, there's a number of communities that we buy where the prior ownership might have had some rental units in there. Sometimes it might be 5 units, sometimes it might be 50. In our entire portfolio today, we own about 3,500 units, 3,500 mobile home spaces. Of those 3,500, we probably have about 400 of the actual homes that we own inside our portfolio. Some of our communities, we have 0 that we own, and others we might have 50 or 60 or 70 that we own, right? And it just varies community to community. But ideally, we would own 0.
Okay. So if you acquire a mobile home park where the current owner owns the home and the land, do you have a process to get the current resident to take over the ownership of
Yeah,
the home?
so yeah, that's a great question. Typically, if there's a renter in there, normally what we'll do is give them an opportunity, try to give them a compelling reason of us financing the home for them or helping them get
Okay.
financing and showing that it's more than likely cheaper for them to actually own that home. However, some folks should be renters, right? They may don't have an interest in being a homeowner. They don't have an interest in being responsible for items that need repaired or investing back in that home. And so it's very difficult to convert someone that is a lifelong renter and desires to be into a homeowner. And so we always attempt to convert if they don't have an interest in buying. Normally what we do is if they're a good paying tenant and a good citizen of our community, then we just let them rent until the time comes where they no longer choose to rent. Once they move out of that unit, we do a renovation and then we put it back on the market for sale. That's normally the protocol that we go through. We've got about 10% of our portfolio is rentals today. We're always going through that conversion process. However, we're always buying new communities. We start whittling that number down and then we'll go buy, like we close on a community tomorrow morning. It's a 6-park portfolio. And inside that 6-park portfolio, there's about 500 sites in total. And of those 500 sites, there's 70 units that are owned by the various communities. And so,
Right.
we'll have to start working towards chipping that 70 number down over the coming years. It's always
Got you.
continual progress.
Yeah, that's awesome, man. So I'm trying to visualize this, right? And if I was to buy an apartment complex and now sell that off to the resident, that creates some complexity as far as cash flow, value, so on and so forth,
So
right?
selling the land, though, we keep the land.
Correct.
We're just
Yes.
selling the home.
So as you sell those homes to the residents, what is the financial impact on the valuation of those parks?
It's beneficial. It actually
Good.
increases the value. You have to bifurcate the valuation. When we look at a park, we're looking at the capitalized income derived from the lots themselves. Just like you would underwrite an apartment complex, the durable income we want is on the lot income itself, not on the actual income from the home if it's a rental. These homes are personal property, classified as what's called chattel. And so they're no different, classification than like a vehicle, a car, a
Right.
truck. So they tend to depreciate in value because they're personal property. They're not attached to real property. When we buy a new mobile home park that has units owned by the community, we evaluate it separately. We capitalize the income on the park and come up with a valuation in that manner. And then we just put a shell value on the home itself based on how old these homes are, the condition. We might say, hey, they're worth $15,000, $20,000, $30,000 a pop. And so what happens is when we can sell that home off, the end user, the desirability goes up quite a bit because most other buyers in the marketplace, especially institutional buyers, don't want to own any homes. They have no
Gotcha.
interest in owning homes. They don't want to be in the rental business because they know that it's just a lot more turnover. The income's not as sticky. Typically, what we'll see is cap rate compression. If we can get rid of all the park owned homes over a period of time and then turn around and sell that property, whereas If it had park-owned homes originally, it might have maybe it sold for 6 cap. But if we can get rid of all those park-owned homes and sell it as a fully stabilized property with no rental units, it might get a 25 basis point, maybe even a 50 basis point premium on cap rate.
Wow.
So we get some cap rate compression because now we're selling an asset that it's got lower maintenance requirements. We don't have to
Yes.
have as much involvement from a community manager to oversee it. We don't have to have maintenance guys on staff. It's really simple and there's very little turnover. We're not involved in leasing homes. We're not involved in selling homes. It's a very simple business model once we can get to that point.
Now that is pretty cool, man. I've interviewed a cost segregation guy. He was talking
Mhm.
about type of properties that has the highest level of bonus depreciation, and mobile home park tends to
Yep,
be one of them, which makes sense, right? Because you pay this high dollar value for land and a small amount of improvement, right? And
that's
being
right.
that the cost segregation mostly is on the land improvements, then
That's right.
you get to have a huge tax benefit for those passive investors who are investing for tax benefits. So yeah, I
Yep.
like that concept as well, man.
About 70 to 75 cents for every dollar of purchase price that we
Wow,
get.
that's
It's
huge.
significant. Yeah, it's a lot. I think car washes are the only asset that actually have a greater bonus depreciation opportunity because of all the equipment they have with them. But mobile home parks, I think, are second line.
Yeah, I got you for about another 7 minutes. Before we get into the focus run, I want to talk a little bit about parking lots. I live here in Hawaii, and parking downtown is probably one of the most lucrative thing down there, man, because they're
Yeah.
so scarce. You go into some major city, you go to like New York, San Diego, different places, Vegas, right? Parking structure, it becomes a scarcity, right? Can you tell us a little bit about that business model? And
You hit one of the important points. It's scarce. In fact, it's the second asset class as the diminishing supply. If you've lived in a certain city for a couple of decades and you can think back to what maybe the downtown area looked like 30 years ago, more than likely there was quite a bit more surface lots than today. They've been redeveloped into condos, mixed use properties, apartment buildings, or office buildings. The land is scarce, especially in densely populated downtown areas. And so we look at parking as an opportunity to buy a prime piece of real estate in a phenomenal location, what we classify as irreplaceable real estate. In addition to that, typically what we buy, we're buying for below replacement cost. The current use today as parking, we know and we're confident that is the lowest use that property will ever have, meaning it can only go up from there. It'll only be
Mhm.
something else at some point in the future. However, we don't underwrite the future. We only underwrite today. And so we've got to make the economics and the business model work as parking at the present time. And so we just closed on a property a couple months back in historic Old Town Philadelphia, literally a block away from the Liberty Bell, 2 blocks from Independence Hall. Irreplaceable real estate that you would never be able to rebuild that parking structure again today. Even if you could spend as much money as it costs to do it, you would not be allowed to rebuild that structure.
Right.
In addition to that, we got it for below replacement cost. In addition to
Mhm.
that, there's just no vacant land left. There's no land, and the demand drivers of why people are parking there. All these tourist attractions, one of the oldest cities in the country, they're
Yeah.
not going anywhere. People are going to continue visiting there, and parking is going to continue becoming more scarce over time. And so that's why we love parking. The last thing to mention is that a lot of parking, just like mobile home parks, just like multifamily, there's opportunities to pull value levers. The parking garage we bought in Philadelphia, we bought from an institutional investor. Most folks think that institutional groups do it all right. They've got all the MBAs, MIT grads, they've got the smartest folks running the show, but they're such big behemoths. There's so many politics involved in making decisions that there's a lot of inefficiencies that get created there. And so, like in that Philadelphia garage, we've already pulled a couple levers and added a couple $1 million in value just by
Oh,
literally
wow.
making some adjustments to the pricing, redoing some minor items such as improving the lighting, improving the safety measures, making people
Mhm.
safe, parking there. Just literally a couple of months improved that value or increased that value by about $4 million. It's a cash flow covered land play. We know that parking is going to be in high demand for many years to come. When that day comes where cars might be flying and we don't need parking garages, I think that's far off in the future. When that day comes, I know that land will be worth something incredibly valuable as another use. Whatever that use might be, I'm not sure, but it will have a higher and best use.
Yeah, that is awesome, man. And no big tenants, toilets, minimal termite because it's straight concrete
Yeah,
buildings.
it's
You know,
concrete or
the,
asphalt.
the plumbing is minimal, fire sprinkler, and the elevators, right? And you don't have to have anyone there working at the kiosk or anything like that. So,
That's right.
yeah, it's very manageable business, man. Man, brother, I could talk to you for a good 2 hours in some of these things, right? And but I know you got to drop that time here shortly, and I want you to talk about the psychology of wealth, how to think like a cash flow investor. Can you talk about that briefly, for like maybe like a minute? What mindset shift separates people who build long-term wealth from the people who chase shiny objects? Maybe like for
Yeah,
30 seconds.
I mean, for me, like cash flow, it's a pretty simple premise. You invest in an asset that throws off
Right.
cash flow ultimately, like you're taking your original principal investment, you're not spending those principal dollars on material items or fancy vacations or a home. You're making a principal investment into an asset that's throwing off cash flow. I think the way to real wealth is letting time take place, watching the value go up on that asset over time. But I think to compound that effect is to take the cash flow from that and then reinvest that cash flow. Buying for depreciation or buying for appreciation, it can work, but it's really difficult to time the cycles. As I'd referenced in 2008, it caught me off guard. I wasn't trying to time the cycle, but it caught me with my pants down where we lost a lot of money, practically everything, because it was really an appreciation game, challenging to time the market. Even the smartest folks, even with AI and all these technologies, it's still impossible to time the market. And so if you buy for cash flow and you buy with durable cash flow and you got time on your side, typically time will heal all wounds. It's easier to heal those wounds if you got positive cash flow coming in at the same time. So I think making sure that you buy assets that have cash flow from day one is the way to go. I know that's difficult and even more difficult nowadays to do. Easier said than done, but the deals are out there. The opportunities are there. You just got to work really hard to find them. This is applicable to anything in life as well. Work harder than your next competitor. Like, you don't have to be smarter. You just have to work harder, work a little longer, right? Grind a little deeper. And I promise you that you'll find success where others don't.
That is awesome, man. Kevin, if our listeners want to get in touch with you, how do they go about doing that?
Yeah, so you can check out what we're doing at Sunrise Capital. You go over to investwithsunrise.com and learn a little bit more about what we do. I'm pretty active on different social channels. I'm very active on LinkedIn. You can search me by my name, Kevin Bupp, and I think I'm the only Kevin Bupp out there. I've got kind of a unique last name, so not too hard to track down.
Okay. Thank you. Listeners, today's conversation was a reminder that wealth is built on fundamentals, discipline, and the right vehicle. You don't need hype. Kevin showed us the niche asset, mobile home park, parking lots, recession resilience, and cash flow. If you want to build true wealth, stick to the fundamentals. Thank you for spending time with us on another episode of the Multifamily Real Estate Experiment Podcast. Until next time, I'm Hutch, the Marine Investor, out.